Add to stage. Okay. New feature, I guess. Figured that out. All right. So interesting day yesterday. Interesting morning this morning. We've got 1 minute to the 8:30 data. 8:15 ADP continues to weaken a bit. Don't have a chart in front of me, but I feel like we peaked a month or so ago with something like a 45, 50 thousand job weekly print, printed 25 and change, down from 29. 8:30 data, import prices blew through estimates. Expected one came in at 1.9, which is in line with last month, which was 1.9 revised to 2. So one could say we're down month over month. Building permits missed, not a great sign, but I don't know that that is a huge mover. Housing starts, big miss. 143 expected, 117 achieved. And also revised down 146 to 139. On balance, definitely bond-friendly data. Those are the housing data from an economic standpoint, from a monetary policy standpoint, from a bond standpoint is like a D-level data point. The weekly ADP, I still think that the market is kind of digesting what that really is and what that really means. Arguably, that's an A data point, but I think we're sort of approaching it and digesting it as like a C plus data point. Anyway, long story short, that the 8:30 round of data really shouldn't, which is everything for today, by the way, really shouldn't have an impact on what we're trading, how we're trading it. Let's pull up the screen here real quick to just talk about what's behind us, therefore, in front of us. Light morning of data, mixed PPI, very similar in the Czech Republic, very similar to what we saw onshore. Hot year over year, but a monthly miss. And this monthly miss was deflationary and down from 1.4. So again, within reasonable context, this is like an F data point, a Z data point for the U.S., but nonetheless noteworthy that, not to sound like a broken record, but we went through a 4, 6, 12-week period of some pretty hawkish inflation data. And the last 2, 3, 4 weeks have, maybe shown a bit of a light at the end of the tunnel. And then when you add on top of it the potential end of this conflict, you start feeling much better about inflation. In Italy, pretty much on the screws, definitely slight miss. So also bond friendly. Wages in the Eurozone came in hot, although labor costs missed. I don't know how the heck that, correlates, but okay. Probably on balance, bond unfriendly. Retail sales, big miss. So, net, I give this, 3 out of 10 in terms of importance. Net, what we're talking about here is bond friendly for sure. Overnight markets, and we talked about keeping an eye on oil and seeing if we can get below 80. We're in the vicinity. Stocks overnight, solid night for stocks. Generally speaking, up in Asia, up in Europe, indicating up here. Almost flat, volatility down again. And here we go, 77 for crude, 80 and change for Brent. And those are welcomed levels for sure, dollar mixed. So, more of what we've been seeing. How do bonds like it? 444, so not quite at yesterday morning sort of pre-market lows. Better than worse levels yesterday. it was kind of exactly what we thought it would be yesterday, right? It was like, hey, this is a deal on a deal for a potential deal. We're still a little bit, we're closer than ever, but please excuse our hesitance. We're cautiously optimistic. And as the day went on, the market kind of traded it that way. We got to the point where, we were basically flat on the day. MBS was still a little bit improved, particularly down in coupon. Our coverage here is still a little bit mixed. We took some coverage at the end of the day. Here this morning, we're short a couple coupons. We're long others, and I'm trying to kind of really thread the needle of long-term, more bullish on rates, short-term, cautiously optimistic, but potentially hawkish just because we don't know yet, right? And this data hasn't been overwhelmingly bond positive, but it's certainly been bond positive. Or maybe better to be said, just not necessarily bond negative. So down in coupon, we're probably up 4 or 5 ticks, maybe on fannies, even scratching to 6, 7 ticks. The belly is sort of right in line with when we were talking yesterday morning, maybe just slightly behind those levels. And so I'm just going to sort of rinse and repeat yesterday. When you look at a 5-day chart, you're in really good shape. When you look at a 1-year chart, a 1-month chart, you're pretty much in line with best levels, give or take close enough with the Fed impending tomorrow for this to be a lock event for me. When you look at a 3-month chart, that's where maybe you start to want to gamble a little bit, even though I always talk about not gambling, right? We're more mid-board on a 3-month, 6-ish month chart. I think when you pull out to 6 months, particularly in the absolute belly, I would almost argue production coupon right now is somewhere in the 5.5. It's like maybe 5.5 plus. You're right in between 5.5, 6 coupon, i.e. 5 3/4 to 6 3/4 note rate, right? Depending on whether you're charging or paying points, so on and so forth. If you're looking at 5.5s, I mean, we're within 30 odd basis points of a clear pivot, 101 the buck. So, long story short, this is not screaming float to me. In a lot of ways, as far as I'm concerned, this market has revealed itself in over the last, 24, 48, 72 hours, whatever it might be, 4 days. In the immortal words of Denny Green, they were who we thought they were. This is exactly what we've been talking about, right? Is once the concern around oil-based inflation, which again is not inflation, but how we talk about it, oil-based inflation subsides, right? What's left? The data. This data does not scream 390, but it also doesn't scream 470, right? So, I think that we've got on 10s, call it, as I mentioned yesterday, 15, maybe 20 basis points in run. On MBS, what does that equate to? 5.5 coupon and up, not a heck of a lot. 25, 30 basis points, absolute blowout. Maybe we get 50 basis points in fee, maybe. To me, what you're fighting for here is 1/8 or 1/4 in rate. The real opportunity is 4.5 and 5 coupon. That's where maybe we have more like 75, 100, and 4.5 coupon might have 150 or 200 basis points in run. And so if you're inclined to work skinny or pay points, all of a sudden 4 3/4, 5 3/8 come back into play where you're paying a couple points, but it makes sense for you too. And I'm not saying it does or it doesn't. At that moment in time, you'd have to kind of make an evaluation. So, long story short is, to me, this is kind of another lock the dip day. This is sort of one of those days where, if we're talking about a June closing, right? and you're out of time here. You've got 2 weeks, and not literally that much, because you've got refi day looming, Fridays, a bond market or a federal bank holiday. So, and then you've got to disclose the lock, right? So, however many days are left, somewhere between, I guess, whatever it is, maybe 4 and 8 days left to make a lock decision. And the Fed tomorrow, you took a chance yesterday, let's say, by floating. That chance didn't necessarily pay off. I'd be surprised if rate sheets were better. I think what you're going to see, depending on when lenders priced yesterday, maybe you're looking plus or minus 15 basis points. I think you could go either way. So you woke up this morning, and if I just look at a 2-day chart, there's your 2-day chart on fives. So where are we? Right around here is where we priced, and that's where we are. Again, ballpark, you're maybe a little better, maybe a little worse. Unless you're absolutely convinced that, let me say it this way. Why would we float into tomorrow? We would float into tomorrow, and I'm talking, purely for June fundings, maybe pre-July 4th fundings, where the market can't truly digest or might not even get the data we need that I'm thinking will help contribute to slightly lower rates. What has to happen? Well, for one, either we need to make a deal by 2:00 tomorrow, and even by then, that's probably too late. But we need to make a definitive deal by 2:00 tomorrow, or the Fed needs to be convinced that there's a deal by 2:00 tomorrow. And then they'd have to get up there. And getting up there means in their meeting and then at the presser and say, war's over. Look at oil prices. We think they're going to go lower. Look at core and super core inflation, and we could directly connect the dots to these gas prices. And now that that's gone, I'm looking at this, I'm looking at that, I'm looking at the other thing, and I'm saying that, and they don't talk in these terms, but just, to kind of keep it simple, I would rate the consumer, and they kind of do talk about it. I mean, they do, they do dots of different kind, and they do economic forecasts. So, their economic forecasts theoretically speak to the consumer. But, on a scale of 1 to 10, I'm going to rate the consumer at a 6 right now, right? And potentially trending to a 4. And I'm going to take the inflation prospects at, given what we know now. And then again, the now is we know for a fact the war is over. And what we've plotted as the trajectory of oil and gas. And I'm going to give inflation prospects, a 5, let's say, right? I think we're going to go back to that path to 2% that we were on just 3, 4, 5 short months ago. By the way, now this is me talking, not them talking. We weren't on that path. We were always going to get a hot inflation number. Had nothing to do with Iran. Let's be clear about that. And I've been calling for that since Q3, Q4 last year, as you know. But now, again, putting my Fed hat back on. I mean, in terms of monetary policy, we think we're right down the middle. We think we're at 5, and we think we might be tracking better. That's what you're betting on if you're betting on a float, okay? Why? Because, as I alluded to yesterday or the day before, our base case is no longer a cut, which it was 30, 45, 60 days ago. It's a hike. So we've got to get the hike to 0 before we start talking about cuts again, right? So do I think that there's a chance that at 2:00 or roughly thereabouts tomorrow, maybe after 2, it comes out in the presser, that we're going to write down the likelihood of a hike in 26 to 0? I think that's a possibility. I really do. I'm not saying that they are going to do that. What I will say is I could see where the bond market and or interested parties, as we might call them, might extrapolate out a hike, right? I personally, unless they got really, really, really skittish and hiked tomorrow, which I don't see, if we don't get a hike in the next 30 to 90 days, I'm going to say we're not going to see a hike this year. More than likely. I've got to do a little bit more of a dive because, again, I've got to see, where we are. And some of what I was going to do this afternoon is just kind of look at where money supply, where we've been from a printing standpoint, dive into some of these numbers a little bit more. But as we're just off the cuff, as I'm sitting here right now, I think the time to hike, if they're going to do it, is sort of now. And I think as the consumer weakens, which I expect, and as the fears of a worst case scenario around inflation subside, I think the Fed, it gets to a more neutral posture. My little disclaimer on that is the way the Fed thinks, right? Anything above 2 should be tightening and anything below 2 should be easing. And 2 itself is neutral, right? Now, literally, you've got to account for tails and you've got to account for momentum and all that other stuff. I don't know that they've ever exhibited the ability to do that. So when you strip away everything, and let's just get in our time machine for a second and go back to February. We were never at 2%. Now, on a monthly, we had some 0.1 prints and even a negative somewhere in there. So we were heading there maybe, right? I know that I've been optimistic the last week, and I know that I'm saying, hey, we're headed in the right direction. And I know that I've sort of ratcheted up my float lock bias to more float than lock the last week. But I just want to give a little bit of pause here and say that in no way, shape, or form am I suggesting that all roads lead to a 3.9 10-year anytime soon. I don't necessarily see that. I just don't think that a great case can be made for floating today. And as I normally break it down, I'll kind of leave you with this before we just talk about tomorrow for a second. If you have any questions, throw them in there. Thanks for watching live and everybody that joins on joining live and everybody that watches on replay throughout the day. And again, tomorrow, my expectation is we're going to do an 8:30 to talk about retail sales, but we're also going to do a 2 o'clock sort of live reaction to the Fed. I think that if you have a good story to tell, i.e., you took a chance, you floated, you now hit, so to speak, I think that you've got to follow through, lock them in, and tell that good story. I think the conversation that needs to be had is, do you want to fight the Fed here? Do you want to? They've been getting increasingly more hawkish. There's reasons for them to ease off that. But, we don't have time to react if it doesn't go our way. I think you should lock. What do you think? We've already picked up an eighth, a quarter, whatever it is that you potentially picked up from floating. I think if you're 6.25 and above, you are banging around the best levels of the year, give or take. I just don't know why you wouldn't lock that. And then lastly, if you've been completely offside for the last 2 months, the last month, whatever, at a 4 3/4 to 5 5/8 or whatever note rate. Yeah, I suppose you have nothing to lose here, right? You might as well float into it. I certainly think there's more upside than there's downside tomorrow. Call it 70-30. I think we come out of it okay. But we'll see. 8:30 retail sales. That is actually what I'm the most interested in tomorrow. What I'm second most interested in is how he handles the presser and how much they reference and or in the presser talk about the inflation expectations in the wake of a full-on reopening of the strait and an end to the conflict. And I'll just go back real quick to, if we're looking at 77 a barrel right now, right? And I'm not an oil guy, so I haven't gone so far as to extrapolate where oil prices might go. Keep in mind, okay, great, we opened the strait, but then we closed the reserve. What does that do? Knowing how hell-bent the president seems to be on lower rates, I think he's going to let this run a little bit. I think that's a reasonable bet, but it's a bet, and that's where I say I think this is a hard one. I think there are a lot more positives than there are negatives, but those positives, sort of really tend to be more about conjecture and extrapolation and dominoes than it is. We just need one thing to happen, right? We need a bad non-farm, and every feeder coming into the non-farm has been terrible, so we can pretty much guarantee that this is going to be a bad number. That's not what we're looking at here. It's a guess of a guess of a guess, but they're really good guesses. So not for the faint of heart. All right, everybody. Bulls and bears make money. Pigs get slaughtered. Thanks. And I will see you guys tomorrow. Have a great day. Good luck day yesterday. So it tells me that a lot of people listened. I would sort of expect the same today. Take care.